Look, this brings us to the final presenter of today, which is myself. I'm going to give you a little bit of an overview of the direct suite of funds. I'm very conscious of the funds that we have in terms of number and the level of information that investors want. By necessity, I will be brief. There will also be a whole bunch of numbers up on the slides here. I'm not even going to try and go through each point, but the reason why we've included them is because it does allow for investors, if they want to look at this presentation again when we put it up online, you can pause it and pull up the information you need. So the first thing I'm often asked, and my team's asked, well, Stephen, how are the funds performing? Importantly, the slide you can see on the screen right now is the core, so the institutional grade, the long leased high occupancy portfolio, which we've been invested in for a long period of time. And what you can see here is the blue bars are the fund level returns of each individual investment versus the grey bars, which are the benchmark returns. The other thing I would say here is we've split up this table, as we usually do, into the fixed life funds, which have a finite term. And on the right-hand side, you can see the funds which are still open for investment. Importantly, at Charter Hall, we very much believe in being transparent and giving investors up-to-date information. So on this front, we had all the assets independently valued at either 31 March or 30 April, and we're going to get them all independently valued again at 30 June. We think that's the best way to give investors confidence around the unit pricing. The other thing to note, I've had a few questions offline around when will I know what the distributions will be for the next financial year. What I would say is we're going through the usual bottom-up, property by property, fund level budget process. We'll get those budgets approved by the end of this month. And then as we hit the June quarter, in the quarterly report that's mailed out to investors at the end of July, we'll give guidance on each of the funds in terms of their outlook for distributions for the next 12 months. The next slide shows the performance of the Folkestone funds. So as you know, Charter Hall and Folkestone merged 18 months ago. What you can see here is the funds have performed generally very strongly. The only two I'd just draw your attention to where the actual results are materially less than the benchmark, you just need to keep in mind that these are development assets where either the development hasn't yet completed or it's recently completed and those assets are in the lease-up phase. So there hasn't been any opportunity to reflect any capital appreciation on those. The other thing worth noting is that the high-quality Folkestone team, who many of you would have been dealing with on these funds, so Ben, Adrian, Scott and Lula are still actively involved in all of these funds, and I know that, and many of you have been speaking to them on an ongoing basis. I'm now going to quickly cover off our fixed life core funds. This slide shows our retail assets, so in that you've got your Bunnings and your Direct Automotive Trust number 1 and number 2. For those who are in the Automotive Trust, you will be aware that at Charter Hall we really needed and wanted to work with our tenant. We allowed them to defer some of the rent, so the rent isn't lost, but it just allowed them to work through some cash flow issues that any business tends to have when you forcibly are shut down for a period of months, or even if the business was still operating, when the government's telling people not to leave their house or socially distance, it makes it very hard to turn a profit. So what you've seen there is we've helped the tenant, which is ultimately in investors' best interest, and again, importantly, none of that income is lost. And the Bunnings Trust, about 18 months ago, we extended all the leases back out to 10 years, and that trust keeps going from strength to strength. Here are our fixed life industrial funds. Those investors who are in CDC Trust, which has a significant interest in the Coles Adelaide Distribution Centre, would already be aware that the asset management team recently achieved a new 15-year lease with Coles, which created a significant valuation uplift, which is why you'll see those 12-monthly returns so high. And it's really positioned that fund, which is great because we're now at the end of the 6-year investment term for that vehicle. So for those investors who are invested, look out in the mailbox, look out in your inbox. We'll soon be mailing you an update and management strategy around that exit. And I think you'll be very pleased in what we've been able to achieve for investors there. In terms of Diff 2 and Diff 3, well, look, they're doing everything they should be doing. With long leases, well in excess of 10 years, 100% occupancy and strong tenants, they continue to provide that regular and growing income stream for investors, as well as that capital growth as those fixed rental escalators kick in each year. This next slide is our latest fund. It's called the Charter Hall Wholesale Property Series number 1, or WPS1. It's much easier to use the acronym. I do want to draw out a few things to note for investors here. Look, this fund, unlike most of our other products, is only available to those investors who meet the sophisticated investor test as defined in the corporations law. The reason I mention that is because it also has a longer investment period of 8 years and does have a minimum investment of $250,000. And you heard me say at the beginning, we're not in the business of giving financial advice. So if this is something you're interested in, I would always encourage you to request the information memorandum, but just as importantly, speak to your financial advisor. You can see here the pie chart, how we've constructed the fund. It invests primarily into our wholesale, industrial and logistics assets. And I often get asked, well, Stephen, what's the point of this fund? Why is it invested into other vehicles? Well, it's very simple. Many of the funds that this invests into, you need either a $20 million to $100 million investment. So the wholesale funds, 20 million plus. Our partnerships and mandates, 100 million plus. So what we've gone to a lot of effort to do is to lower the entry point to make this highest quality funds available to our high net wealth clients. This brings me to our flagship fund, the Direct Office Fund. It's been in existence for the longest term, back to 2006. It's over $2.2 billion. You can see there, I won't go through the key stats on occupancy and lease term. There's a very consistent thematic. Anyone that's heard me speak will have heard the same thing. We focus on long-term leases, high occupancy levels. All occupancy levels exceed the Property Council benchmarks. But what's really important, and what's shown in the crisis like we've seen, is it's just as important who's paying the rent. So you can see there on the slide, the top tenants are government. Almost 30% of the portfolio's net property income is paid by federal or state government tenants. That's terrific. And why am I mentioning that? Well, it's terrific because they have the highest credit rating and the government will always pay you the rent. If you then go down, you see other tenants such as Suncorp, Coles, Western Sydney Uni and Westpac. This isn't an accident. You heard from David at the start. We've been very deliberate in achieving this strategy of long leases to strong covenants because we believe that's the best way to continue to deliver income for investors. The PFA fund, again, the biggest tenant, over 50%, government tenants. The fund has now grown to over $1.2 billion, and we recently secured a new development in the Innovation Quarter out at Westmead, near the big hospital, underwritten by the Western Sydney University and CSIRO as key tenants. Again, going down, you can see the other tenants, American Express, Horizon, a huge company, Lion. Those top 4 tenants are around 75% of the net income of PFA. Moving through to our open industrial and logistics fund, and I should mention both DOF and PFA are also open for investment. We've consistently grown this. We've taken the themes of what we did in industrial fund number 2 and 3 and simply rolled them out into number 4. At $600 odd million of gross asset value, this fund is one of the largest unlisted industrial funds available to high net wealth, self-managed super funds and retail investors. The tenants, Main Freight, you often see their trucks going around. Well, who are they? They're a $4 billion market cap entity listed on the New Zealand Stock Exchange. They do basically logistics, third-party transit, and it's a big growth area. Primo, largest small goods, so meat processing company in the world, as well as Ingham's, another key tenant, basically a duopoly in this country between Ingham's and Steggles, and that benefits from a very long-term lease, which is great for investors. What I would say with industrial and logistics, you do tend to get longer lease terms than what you can achieve in the office sector. It's just a function of those markets, but you do tend to also have slightly lower fixed rental increases coming through. It's not that one's better or worse than the other, it's just different factors in those respective markets. The next fund, DCSF, well, look, for those investors in this fund would be aware we've had to temporarily reduce the distribution rate. There's no shying away from that. Although we set this fund up to be extremely defensive, what's happened for those properties that are located in CBDs, such as the Brisbane CBD, we've got a government that's rightly closed it down and office workers being non-existent. Obviously, what we're trying to do there is help tenants through that short-term cash flow process. And even after those reductions, it still is achieving, as we stand here now, a 5.6% income return for investors. So this fund pays monthly distributions, and we don't expect that reduced distribution to continue. It's likely that we'll wait for a period of time till we've got more confidence on where the pandemic situation is, and then later on in this calendar year, those distributions will be increased. The next slide is something which we haven't necessarily focused on previously, but it is an important piece of an investor's portfolio. So the funds I've been talking about so far relate to unlisted funds, so they're not on any stock exchange. Well, pleasingly, we've now got a very high quality fund called the Maxim Fund, over $160 million of stocks. And what it does differently is it invests into the listed real estate markets on the ASX. So what the big difference is that it provides liquidity and is a lot more liquid property exposure. Having said that, just because there's liquidity doesn't mean you should trade in and out of something on a weekly, monthly basis. Like you'll hear from any good financial advisor, investments should be considered over the appropriate timeframes. You can see it's very well researched externally, and the returns continue to beat the benchmarks that's set for that fund. So I'm not saying that Maxim is a better option than the unlisted funds, or unlisted are better than listed. What I would say is they offer different points of difference for your portfolio. If you're after exposure to a listed market that's liquid, well then perhaps Maxim's something worth considering. If you're happy to invest into a product that will lock your capital up for 3 to 5 years, depending on the review event, then the unlisted may be something that you're interested in. And finally, I'm just going to wrap up with a couple of recent acquisitions. I think giving people a real understanding of what we've been buying and the rationale gives you an insight into our thinking at Charter Hall. So the first asset you can see there was acquired by Diff4. We teamed up with our $5 billion industrial wholesale fund, and it purchased a long-leased asset in Erskine Park, a core industrial market west of Sydney, on a long-term lease, 100% occupied, and that's a real core asset for that fund. You will have seen on my cover slide, which I've repeated here, the PFA's most recent asset out at Macquarie Park, underwritten by a long-term lease to the New South Wales government. You've got a WALE, again, weighted average lease expiry of almost 10 years. And as I said earlier, the benefit of having government tenants is you have certainty that they'll continue to pay the rent through all different cycles. And as I've been asked before, well, what happens if the government does stop paying the rent? I say, well, they're contractually obligated, and if that case ever happens, this will be the least of your concerns. And finally, some recent acquisitions we made earlier in this calendar year in DCSF. We picked up 2 healthcare trust or assets on 10-year lease terms. So that's the kind of defensive asset class which we like. Long-term lease, high occupancy, strong tenant in Helios, and providing exposure to that healthcare sector. I've put up on the slide here the contact details of the key team members that are involved in direct investors. You can also see on the right-hand side our general investor number, as well as our registry details. The registry I encourage you to contact if you need some administrative things around investment statements and so on, unit prices. And you can see there the bottom line, our team, if you have any questions. And I mention that because I am very aware we've been inundated with questions, but due to time constraints, we simply don't have the forum here and time to get through them all. So with that, I'd like to close. I'd like to thank you for joining us at the 2020 Charter Hall Direct Market and Fund Update. I'd also like to thank our guest speakers, David Harrison, Andrew Ballantyne and Nikki Hutley, for their insights. We'd love to get your feedback on today's event. We are very much focused on educating our audience, and for those that have dialed in today, you will receive a 2-minute survey. Please, if you can, fill it out. We're very focused on improving the experience, and we want to cover off the topics that are of most interest and relevance to you. Thank you very much for joining this event.